Are you looking to retire early and enjoy life while you're still young? Well, today's video has some great insights on how to make your dividend investments work for you, so you can achieve that financial freedom sooner. So in this video, we'll talk about dividend investing. It's a smart strategy to secure a steady income every month. The only catch? It usually takes quite a while to see significant results. But what if I told you there are ways to fast-track your retirement through dividends? Sounds intriguing, right? Keep watching till the end to learn more about these in detail. Dividend investing is all about buying stocks in companies that regularly pay dividends. This steady income stream makes it a top choice for retirement planning and even during market downturns. Just look at Warren Buffett. He's a big fan of this strategy, and it's a key part of his success. Now, how much do you need to live off dividends? Well, that depends on your lifestyle and spending habits. On average, Americans spend about $67,000 a year or $5,600 a month. You can adjust this figure based on your personal expenses. If you're frugal and keep your spending in check, even a modest investment in dividend stocks can cover your basic living expenses and leave some extra cash for fun. The more you invest, the higher your income potential. Setting a goal of $40,000 per year is often enough to cover your basic needs. But let's be honest, dividend investing does require some patience and discipline. However, two strategies can speed up your path to financial independence. First up, we've got covered call ETFs. Now, what's that, you ask? Exchange-traded funds, or ETFs, are like diverse investment baskets traded on stock exchanges, typically tracking an index or various assets. But a covered call ETF takes things up a notch. It adds an income strategy by selling call options on its holdings, aiming to generate extra income, although it might limit its capital gains. So, while ETFs offer diversification, covered call ETFs focus on generating income through options. These funds make money from both stock appreciation and dividends by writing call options on the stocks they hold. This means they receive premium income and potentially profit from capital gains if the stock price rises above the call option strike price. Some of the popular covered call ETFs include QILD, XYLD, and RYD. These funds offer double-digit yields, which are a lot higher than what you'd get from many traditional dividend stocks. For instance, the 12-month trailing yields for these ETFs are impressive. QYLD with a 15.96% yield, XYLD with a 14.18% yield, and RYD with a 13.76% yield. The beauty of these ETFs is that they provide income from both dividends and option premiums, offering a more stable source of passive income. Let's take SCHD for example. Over 5 years, it showed a 69.19% total return when dividends were reinvested, compared to an 8.6% return without reinvestment. Reinvesting dividends can significantly boost your returns, making a substantial difference in the long run. So there you have it, a few strategies to help you retire early and make the most of your younger years. If you found this video helpful, don't forget to hit that like button and subscribe for more awesome content. Let's break it down in a more casual way. Imagine you're setting aside $200 a month for 20 years. If you're getting an average return of 8.6%, you'd have around $118,449 at the end. But if you reinvest your dividends and see an average return of 13.8% during that same time, you could expect a total of about $216,031. That's a $100,000 difference. The longer you let your money grow with compound interest, the cooler the results. Now, if you're thinking about investing in some ETFs, there are two good options. VIG, which follows companies that have been increasing their dividends for at least 10 years, giving you stability and potential for bigger payouts over time. And then there's DGRO, which focuses on stocks with uninterrupted annual dividend growth for at least 5 years and a responsible earnings payout ratio. These ETFs may not have the highest yields, but they offer strong potential for long-term growth, making them a pretty attractive choice. DGRO mainly deals with big companies in sectors like healthcare, financials, information technology, industrials, and consumer staples. It shares some top holdings with VIG like Microsoft, Apple, Johnson & Johnson, and JP Morgan Chase. DGRO's dividend yield is 2.5% with an expense ratio of 0.08%, and it's currently priced at $52.22, showing a 4.73% increase year to date. Now, some folks really like SCHD when it comes to dividend ETFs. It's got a higher dividend yield of 3.51% and a pretty impressive dividend growth rate. With a consistent double-digit compound annual growth rate, or CAGR, averaging about 13%, it's an attractive option for long-term investors. So here's the deal. Reinvest those dividends and pick ETFs with solid dividend growth potential. The key takeaway is that you should invest more money to maximize your dividend returns. It's all about compounding interest over time. Let me give you an example. But before that, hit subscribe and press the bell icon to embark on a journey of financial knowledge with us, which can change your life. Investing $200 per month at an 11% compound interest rate over 20 years would get you about $155,000. Bump that monthly investment to $1,000 and you'd end up with $778,000. Go big with $2,000 monthly and you'd be looking at nearly $1.6 million. To make these investment dreams come true, experts suggest a three-step approach. First, get your short-term game together by setting up a budget and cutting down on some expenses to kickstart your financial discipline. For the mid-term plan, you'll want to increase your income and invest wisely. Think about side hustles, part-time gigs, or offering your skills for pay. Even if the work isn't glamorous, that extra cash can do wonders for your investment account. Now, for the long-term strategy, aim to create a source of passive income. This could mean starting a business or a YouTube channel. Keep in mind that this path requires some hard work without immediate financial rewards. And here's a pro tip. Always reinvest any profits you earn from these ventures. It's a strategy that's worked wonders for my YouTube channel, which now generates income on par with my full-time job. So there you have it, the secret sauce to making your money grow over time. Let's chat about some investment options that can help you secure your financial future. Specifically, we're talking about covered call ETFs, real estate investment trusts, or REITs, and Dividend Aristocrats. These avenues offer opportunities for earning a steady income through dividends, but each comes with its unique set of considerations and risks. First up, covered call ETFs. While they can be a great investment, there's no avoiding the fact that they carry some risk. The options they're based on may expire worthless, or the underlying stock price might take a hit. So the big question is, how much do you need to retire comfortably with covered call ETFs? If your goal is to generate an annual income of $40,000 from these ETFs, you typically need to invest between $250,000 and $290,000. Not too shabby when you compare it to the staggering $2 million you'd need to invest in traditional dividend stocks to achieve this same income level. Moving on to REITs, which operate as teams investing in properties like malls, offices, and apartments. REITs such as Two Harbors Investment Corporation, Brandywine Realty Trust, and Orchid Island Capital Incorporated offer enticing dividend yields ranging from 19.4% to 20.3%. These REITs have a track record of consistent income distribution through dividends and have historically delivered an average annual return of 10.8% over the past 2 decades. However, keep in mind that REIT investments are subject to economic fluctuations based on property rentals and market conditions. To generate $35,000 per year with a 10.8% return, you might need to invest approximately $320,000 in REITs. Consistent saving and reinvesting dividends can potentially lead to financial independence within 5 to 7 years. Now, let's talk about Dividend Aristocrats. These are S&P 500 companies known for increasing dividend payments for at least 25 consecutive years. Companies like 3M, Leggett & Platt, and Walgreens Boots Alliance belong to this elite club. While their dividend yield may be a bit more modest, around 7%, these stocks provide a stable income stream. To yield $2,900 per month at a 7% rate, you'd need an investment of approximately $500,000. For anyone looking to explore these income-generating avenues, it's essential to have a clear financial goal and a well-structured plan. Understanding your financial needs and risk tolerance is crucial when selecting the right investment option. Diversification across multiple Dividend Aristocrats or REITs can help mitigate risk, and it's wise to monitor your investments regularly. So, are you ready to take action and start your dividend income journey? What's your first step going to be? Share your thoughts in the comments below, and don't forget to hit that like button and subscribe for more insightful videos. Thanks for watching.